Loan structuring for investors. Loan structuring for investors is very important, and there's two big considerations when you're looking at the right loan structure. One is that we need to have the right loan splits in place. You might have an owner-occupied mortgage with an owner-occupied split, and then we're going to get access to the equity, and we want to split that off into its own BSB and account number so that we can track it. We know what equity was used for what property, and then we can come back and address it at a later time after we've done our acquisitions. The second part of loan structuring is where we hold our debt. So in Australia, we can purchase property in three different ways. One is in our own name, individuals or a couple. The second way is in a self-managed super fund. So with the right structure, we can set that up and it can borrow money and leverage as well. A little bit different to your own name. And then the third area is that we can borrow money in entities. That could be a company or a trust. And there's different mechanisms of which is right for you and not right for you. So when you're borrowing in your own name, you're able to, it's typically, you might have an owner-occupied mortgage and you're borrowing some equity to buy an investment property. We typically see that in your own name. When you go to buy an investment property and you buy it in a company or a trust, the loan is then owned by that company or trust. It's an entity unto itself, but it has you as the person behind it to be able to support it with your income and your direction because you're the person that owns that entity or company trust. To give a definition around company, a company is a proprietary limited entity that allows you to either trade a business, but in the case of investors, it's when we hold property there and it becomes an entity that's just passive that holds property and generates income, or rental income. A trust is a specific guideline document that usually has a trustee. Most of the time for property investors, it's a company as the trustee for the trust, and the company acts as the direction and guidance and controls the trust, and the trust document asks how you're going to distribute the money, how it's going to be invested, and whether it can borrow money. So it's just a big document that sits behind the trustee to be able to direct how the money is going to be distributed. So it's all owned by not you as a person, but the trust or the company. Self-managed super funds, on the other hand, are a little bit more regulated, and because they're more regulated, they're a little bit more straightforward. So you might have a superannuation fund that just pops up on your payslip. That's all you see most of the time is you see the super fund and it's getting a few percentages of your income going into the super fund, and that's all you see mostly, and you get an annual statement. But with self-managed super funds, this is where your current super fund could be converted into a self-managed. That allows you a lot more control over what your super is invested in. And in Australia, we can invest in property, and we can also leverage and get the bank's assistance to be able to buy a bigger asset. So you might have a few $100,000 in super. The bank can throw a few extra $100,000 at it as long as the super fund can repay it. And that's a separate entity altogether. It doesn't have an impact on your personal borrowing capacity, and it also has its own borrowing capacity as well. So loan structuring for investors, make sure we got the right splits and we know the impact of equity for the purchase of the next properties. We have it separated from our owner-occupied debt and our investment debts, so all in its separate splits. We can have the right offset accounts to be able to manage the surplus cash that we have and the buffers that we need to manage our investments. We can own our debt in our own name. We can structure debt into entities, companies, and trusts, and we can structure debt into a self-managed super fund. And all those three areas, if we focus on all three areas, that way we can maximize our investment potential and wealth creation.